These files were never meant to be public, but someone reopened them. This is the Dark Bureau. Some banks are less visible than others, by intent, not accident. Their names rarely glisten from high-rise buildings, nor do their logos trail jet engines across city skylines. Absence from public view is their only real presence, a reflection of a different kind of power. In nations smaller than bustling metropolises, something remarkable happened. Billions coursed through the banking system in a continuous silent current. These transactions surfaced briefly in accounting ledgers, flickering before fading into silence. Regulatory alarms might trigger, short-lived, muffled clicks barely piercing the surface. Again and again, ledgers balanced quietly, while routine screenings missed the signals of something far from routine. In this world, invisibility is not the result of oversight, it's the foundation of the system. These financial flows were not the product of isolated greed or solitary actors operating in the shadows. Instead, they revealed a carefully calibrated structure, a latticework of intermediaries, rules designed for show, and gaps left by intent rather than error. Institutions became symbiotic, not antagonistic, to clandestine objectives. Behind a varnish of compliance, an alternative process played out, using existing tools for unprecedented scale. If the world's attention ever flickered this way, it would find not chaos, but choreography. Yet the real intrigue lies not simply in the pattern, but in the question: how did assets from some of the most trusted banks in the region become global vectors for risk? How did the pillars of local prosperity evolve into unseen conduits for international crime? This story resists simplification. It is not a matter of corrupt managers in windowless rooms, nor is it an isolated lapse in an otherwise well-policed system. At its heart is a region suspended between East and West, between intense scrutiny from the European Union and enticements from the vast and shifting East. From Tallinn's medieval ramparts to Riga's boulevards, an apparent prosperity bloomed, catalysed by an influx of foreign deposits. But beneath the economic rejuvenation, the mathematics stopped adding up. Some banks grew their balance sheets so quickly that the relationship to the local economy snapped. Government statements issued in the language of reform, brimming with confidence, ultimately failed to account for the sheer velocity and volume pouring through these institutions. Transactions originated in distant jurisdictions, swept through layers of intermediary accounts, and washed up in Western Europe beyond trace's reach. No algorithm or regulator assigned to monitor this could keep pace. No law on the books could preempt a system built by and for ambiguity. What emerged was not accident, but engineering. Opacity optimized, compliance filtered for speed and deniability. The real investigation is not about wire transfers gone astray. It's about dissecting how geopolitical fault lines, regulatory ambition, and the politics of profit align to leave entire nations exposed. The evidence is overwhelming. Reams of transaction records, leaks of confidential audits, and painful testimony from those who tried, and often failed, to blow the whistle. The scale only comes into focus when these fragments are assembled, beyond the limits of what any one agency or government could see. The full anatomy of the Baltic money pipeline reveals a paradox. Even as rules for oversight thickened, the means for evasion grew faster still. These ghost banks did not rely on darkness for shelter. Instead, they orchestrated a spectacle of pseudo-transparency. Discretion was the policy, and legal access was always, for the right price, available to those who knew how to ask. We begin in the archives, in the deep file storage of Baltic regulators. Rows of wooden shelves, creaking under the weight of overstuffed binders, stretch from cracked linoleum floors to flickering lights above. The illusion of control is carefully staged. Desk calendars marked with audit deadlines, headlines in official gazettes trumpeting diligent oversight, staff gathered for compliance seminars. but peer beneath the surface into the patterns of inspection reports and the repetition of the same boilerplate warnings, and a more unsettling picture emerges. After the end of the Cold War, the Baltic republics remade their financial orders at breathtaking speed. Within a decade, new legal frameworks promised modernity, signalling to Western partners that any risk of post-Soviet dysfunction was now history. Anti-money laundering laws, planned with foreign advisors, entered the statutes. Yet on the ground, frontline agencies lacked both the staffing and technical expertise to probe the origins of massive capital inflows. Permissive banking licenses multiplied, far outstripping the needs or means of the local economy. Central to the system was the rise of front banks, relatively small domestic financial institutions that sprang up in the late 1990s and early 2000s. Designed to attract foreign clients, these banks rapidly became magnets for offshore interest, building portfolios that dwarfed those of their Western European counterparts in relative terms. Their clients were often faceless corporations, legal entities established via proxy, shielded by lawyer-client privilege, or purchased by the dozen through online facilitators. For every layer of shell ownership, scrutiny between real money and phantom identities grew fainter. Due diligence was enacted only to the letter. Boards and risk departments, aware of the revenue at stake, faced a collision of interests. The job of vigilance clashing with the pressure to expand services and delight intermediaries. Each new account added another pane to a labyrinthine glasshouse, barely distinguishable from legitimate commerce. Nominally, the regulatory environment appeared strict. Statutes and directives guided banks to vet their customers, monitor for suspicious behaviour, file reports with central watchdogs, and ensure their employees understood the stakes. But the actual task proved insurmountable. Compliance units overwhelmed by the volume of activity, audits becoming a box-ticking exercise, and political leadership hesitant to imperil lucrative flows. By the mid-2000s, an internal contradiction emerged. National regulators were lavish in ambitions, but impoverished in both resources and political will. Bank secrecy was neither fully discarded nor transparently managed. Instead, it was calibrated to attract maximum capital inflow without inviting outright scandal. A crucial innovation was the use of correspondent accounts. To function as global gateways, these small Baltic banks maintained accounts with established institutions in Germany, the UK, or Nordic capitals. This infrastructure allowed clients, often holding opaque corporate structures in Cyprus, the British Virgin Islands, or Russia, to move funds seamlessly. Every transfer that arrived in a Latvian or Estonian bank could be passed onward as an apparently legitimate transaction, eventually settling in the accounts of large European banks. In effect, these correspondents became both validators and blind spots, trusted until proven otherwise, and rarely checked for the true origin of funds. It was here, in the interstitial spaces between local and international oversight, that the pipeline achieved its efficiency. The complexity was institutionalized. Layers of front companies obfuscated true beneficiaries, while certain banks specialized in rapid incorporation services. Law firms and accounting shops acted as intermediate custodians, often unwitting, sometimes not, further distancing final recipients from funds' origins. Western real estate, luxury goods, and high-yield investments absorbed the capital's exit velocity. The scheme drew strength not only from regulatory forbearance, but from a growing network of enablers, including compliant notaries and brokers willing to wave off unusual activity. Analysts called this regulatory arbitrage, taking advantage of uneven implementation of laws across jurisdictions to route funds where scrutiny was lightest. International authorities, Europol, the FATF, and national central banks sounded early warnings. In periodic assessments, they noted explosive growth in non-resident deposits, the prevalence of complex corporate structures among clients, and a worrying trend of activity misaligned with underlying economic indicators. Yet these red flags rarely translated into decisive action. Compliance officers occupied a thankless no man's land, tasked with filtering thousands of transactions daily. The overwhelming majority met technical criteria, modest sums below legal triggering thresholds, routine destination countries, or clients with the minimal paperwork required. It was nearly impossible to distinguish authentic commerce from sophisticated laundering in the crush of activity, leading to the perpetuation of risk rather than its attenuation. Where regulatory action was attempted, it was commonly diluted in committee or delayed until funds had long since moved elsewhere. Audit reports noting repeated anomalies piled up but gathered dust or were quietly logged and set aside as pending clarification. Internal risk committees hesitated to escalate concerns, wary of challenging institutional growth imperatives or angering influential clients. The division of responsibilities across auditors, management boards, and regulators, intended to safeguard against groupthink, fragment accountability, and made effective oversight difficult. Meanwhile, the external structure appeared steady. In fact, it was quietly fracturing from within. The pivotal moment came with the emergence of whistleblowers. For years, internal warnings about systemic issues and compliance gaps went ignored, regarded as professional pessimism or corporate risk aversion. But under mounting internal strain, several insiders began to break ranks. Their disclosures were startling, offering the first granular maps of nested accounts and circular transaction structures. Leaked correspondence detailed how certain clients exploited the system, initiating transactions in one Baltic jurisdiction, layering them via several shell companies, then routing funds through Western clearing institutions to final recipients across Europe or further afield. Some whistleblowers documented personal reprisals and professional ostracism, underscoring both the fragility of institutional culture and the courage required to speak out. Their evidence reframed the entire debate. What was once dismissed as isolated compliance failures was now proven to be the legacy of calculated neglect. Structural, not incidental. Multiple independent and cross-border investigations followed, often spearheaded by international working groups and investigative journalists. Forensic analysis linked transactions that spanned Latvia, Estonia, Cyprus, London, and Switzerland. By overlaying transaction timelines, authorities finally pieced together how seemingly compliant activities were coordinated to flow in parallel, mimicking legitimate movement, but neatly evading deeper probes. Major Western clearing banks found themselves unwitting hosts to flows exceeding even the most pessimistic early estimates. Public scrutiny increased, and in response, some institutions initiated their own internal reviews and suspensions, while others downplayed the scale and systemic impact. The myth of isolated regional corruption evaporated. This was now a pan-European concern, implicating legal, compliance and supervisory infrastructure from Tallinn to the City of London. Yet the consequences ran deeper still. Structural vulnerabilities persisted, even as high-profile scandals forced short-term closures and recapitalizations. In many cases, as regulators succeeded in shutting down one avenue, the market rapidly reconstituted itself elsewhere, driven by the same global incentives. The rise of compliance fatigue set in as institutions became overwhelmed by new checks and mandatory reporting. There was a risk that real vigilance was replaced by paperwork, creating a hollowed-out sense of progress. Policymakers attempted to strengthen cooperation and harmonise anti-money laundering regimes, but every advance met new strategies of concealment. The market for reputation management, compliant on paper, dangerously informal in practice, flourished. Real-world impacts proved profound. Confidence in Baltic banking evaporated almost overnight, leading to bank runs, emergency interventions, and forced liquidations. Billions in suspect assets were eventually frozen or seized, clogging court systems with complex proceedings. The collateral damage spread. Legitimate businesses faced suspicion or exclusion from global finance, investors recoiled, and the region's hard-fought reputation for transparency was severely eroded. Western banks faced enormous liability exposure, and correspondent relationships came under strict new review. In some cases, banking giants curtailed ties, fearing repeat scandals or regulatory backlash. Meanwhile, political tensions erupted within the EU over the unevenness of enforcement and the reliability of cross-border safeguards. The societal cost is ongoing. Residents of the Baltic states watch their economies transformed, sometimes revitalised, often destabilised, by patterns of abstract risk. Regulatory reforms, pushed through after highly publicised failures, made it harder for genuinely innovative or small businesses to access banking services, creating new bottlenecks for legitimate growth even as ongoing vulnerabilities remained. The lesson is now indelible in institutional memory. Financial integration without harmonised, enforceable oversight breeds not only risk but dependency on opacity itself. What began as a regional experiment has become a global warning. When the speed of capital outpaces the reach of the law, and when institutional incentives reward the concealment of truth, whole societies pay the price. The ghost banks of Eastern Europe were not rogues. They were inevitable products of a system where power preferred darkness to daylight.